Welcome to Rising Influence. In today's video, we're excited to explore a fascinating topic: the intriguing shifts within the budget airline industry. While many low-cost carriers face challenges such as rising fuel costs and stiff competition, there's much more to uncover about what drives these changes. Join us as we examine the key factors shaping the landscape of budget airlines today.
People not able to get on these American Airlines flights, and it couldn't come at a worse time.
But according to flight tracker FlightAware, more than 40% of the airline's flights today have been delayed. And now the holiday countdown clock is running out.
Let's take a moment to reflect on an extraordinary transformation in the skies. 8 years ago, American low-cost carriers thrived, confidently charting their course with impressive profit margins. For instance, Southwest was raking in an incredible 20 cents from every dollar in operating profit, while JetBlue and Spirit were just behind, each boasting 20% and 24% margins, respectively. Allegiant even pulled ahead with a staggering 30%. These figures were remarkable for any industry, especially aviation. Low-cost carriers flourished, easily outpacing their legacy counterparts. Delta peaked at 19.6% and United at 13.6%. Everyone was buzzing about the secret behind these incredible profits amid the lowest fares. Fast forward to today, and there's a notable shift. Legacy carriers have regained a competitive edge, and low-cost airlines are now in a challenging position, facing operating margins that range from 5.6% to negative 11.2%. Meanwhile, their legacy rivals are bouncing back with margins closer to their historical highs, hovering around 8% to 10.9%. So, what led to this turnaround between 2016 and now? Of course, one significant event was the COVID-19 pandemic, which caused a dramatic downturn in air passenger volumes, representing a pivotal moment in modern aviation. However, the story continues. The good news is that passenger volumes in the US have entirely rebounded, even reaching an all-time high during the summer of 2023, with promising indicators that this trend will continue into summer 2024. While COVID-19 impacted all airlines, the recovery story is different for budget carriers as it is for legacy ones. Their financial performance experienced a downturn, while legacy airlines not only recovered but have continued to grow. It's intriguing to note that the budget airline model is facing unprecedented challenges, even with soaring demand for air travel. However, airlines must convey a narrative to their investors, especially since public companies are accountable to their stakeholders. For instance, Spirit Airlines explains its challenges by stating, "The competitive environment remains challenging due to elevated capacity in many of the markets we serve, indicating that it may be operating in a crowded marketplace." A closer look at the numbers reveals that demand recovery post-COVID has yet to be uniform among different market segments. While leisure travel is booming, more digital businesses are now opting out of extensive travel for meetings and conferences, resulting in business travel staying within its pre-pandemic levels. This makes sense when we consider that leisure travelers are eager to fly, leading legacy airlines, traditionally focused on business routes, to adjust their networks to accommodate the increased leisure demand. Let's take Las Vegas as an example. In 2023, the city had 412,000 scheduled flights, up about 10% from pre-COVID averages, highlighting the thriving vacation market. In contrast, New York's JFK Airport, a significant business hub, still recorded slightly fewer flights than it did before the pandemic. But there's more to the story than just competition. Spirit's assertion that oversupply is the primary driver of its issues only tells part of the tale. An analysis of its load factors shows a decline, where 84.7% of seats were filled in 2015. It has dipped to 81.3% today. This drop does correlate with increased competition and additional capacity in the market. Still, it's also crucial to understand that price fluctuations can affect flight demand, as consumers decide to travel based on ticket costs. While Spirit has experienced a lower load factor, its revenue has proven relatively stable. In 2015, Spirit earned about 10.08 cents per seat per mile flown, which has changed slightly to 9.63 cents today, peaking at 10.44 cents in 2022. While that may seem like a notable drop, it's not significant enough to fully account for the remarkable shift in profit margins, from 24% to negative 7.5%. However, another critical factor is the cost per available seat mile, CASM, which is the operating cost incurred by airlines on a per-seat, per-mile basis. Between 2015 and 2021, this cost fluctuated significantly, greatly impacting budget carriers' ability to maintain profitability in a shifting marketplace. The landscape of budget airlines is challenging, but there's an undeniable excitement in how the industry adapts to evolving reality. It's a dynamic story filled with opportunities to innovate and transform. Stay with us as we continue to explore this ever-changing world of aviation. Navigating through the latest financial reports, it's clear that while rising fuel prices present challenges, airlines are optimistic about addressing one fundamental aspect of their operations: irregular operations. There's a growing realization that maintaining on-time schedules in the US has become increasingly complex. This situation significantly impacts the low-cost carrier model, which thrives on efficiency and reliability. Before the pandemic, Spirit Airlines consistently achieved remarkable aircraft utilization, often flying up to 12 hours daily during the bustling summer season. They operated a tight schedule from early morning until late night, maximizing their aircraft's potential. Even with a strong travel demand, Spirit is working hard to reach those pre-COVID utilization levels, peaking at about 10.8 hours in 2023. Although this is a drop, it's important to celebrate the progress they are making in challenging circumstances. Various factors contribute to these operational hurdles, with increased severe weather being significant. For instance, the US has seen a rise in the frequency of major storms. In 2000, there was typically just one Category 4 or 5 hurricane per year, but now that number has climbed to over 2. Given that many of Spirit's routes connect to sunny destinations like Florida, well known for their beautiful beaches but also vulnerable to hurricanes, these weather challenges directly impact their on-time operations. Consequently, airlines are adapting by building additional slack into their schedules to manage these disruptions effectively. Another considerable factor is the air traffic controller shortage facing the FAA. With each controller able to manage a limited number of flights, this shortage leads to delays. Unfortunately, this has had a particular impact on Florida. However, this situation highlights an area for potential improvement and innovation in scheduling that can enhance efficiency in the future. Adding to the mix, nearly half of Spirit's fleet features advanced Pratt & Whitney engines, which present exceptional performance but have recently faced inspection challenges. The manufacturer identified a possible component flaw that could lead to turbine cracking, resulting in a proactive maintenance approach that temporarily grounded several aircraft. While Spirit faces these hurdles more acutely because it relies on this engine type, it demonstrates resilience as it navigates adjustments to keep its fleet ready and operational. Other airlines utilizing similar engines are also feeling the pressure, which allows the industry to work collaboratively to address these challenges. Despite the lower aircraft utilization rates, Spirit has encountered a few bumps in on-time performance compared to pre-pandemic times. This scenario does lead to additional operational costs, whether from compensations for cancellations, unexpected hotel bookings, or lost revenue due to passenger dissatisfaction. However, challenges pave the way for innovation and adaptation, leading the industry to rethink strategies to enhance customer service and operational reliability. All U.S. low-cost carriers are exploring creative paths to secure their future in this evolving landscape. JetBlue, for example, is embarking on a dynamic journey by redefining its route strategy. They've opened up exciting long-haul flights to European destinations, utilizing narrow-body aircraft with an impressive number of business-class seats. Initial responses to this service have been promising, with plenty of positive reviews and expanding destination offerings. Interestingly, JetBlue initially offered scheduled year-round services for these routes, keeping the same seat capacity in the winter as in the summer, even though winter demand is lower. Now, facing economic pressures, they are smartly adjusting by transitioning specific routes to summer-only offerings. Aircraft from these routes are being redirected to busy domestic markets, strengthening their service from Phoenix to the East Coast and on routes like New York to Vancouver and New York to San Juan. This agile approach reflects a broader trend in which leisure travelers are increasingly willing to invest in premium experiences, especially on vacation. Low-cost carriers have tremendous opportunities to cater to this growing market, allowing them to rethink and refine their business models to enhance customer satisfaction and profitability. As airlines embrace these transitions, it's clear that the spirit of innovation and adaptation is alive and well. The dedication of carriers like Spirit and JetBlue to weather these challenges and emerge more robust and responsive to travelers' needs is truly commendable. With a focus on more intelligent operations, enhanced customer experiences, and adaptability, the future of low-cost carriers looks bright, fostering renewed excitement in air travel for everyone. Exciting times are ahead for Frontier Airlines as they embrace remarkable transformations. In a bold move announced in May 2024, Frontier is shifting away from the traditional budget airline model that many passengers are accustomed to. Instead of charging extra for seat assignments, carry-ons, and change fees, Frontier is moving toward a pricing strategy that resembles that of major legacy carriers like United, Delta, and American Airlines. This means passengers can look forward to bundled fares that enhance their travel experience, such a refreshing change. From the passenger's viewpoint, this transition brings Frontier closer to what travelers expect from established airlines, which is an exciting development. Behind the scenes, the airline makes notable operational changes, simplifying its structure and making travel smoother and more efficient. In the past, Frontier had a complex operational model with numerous random routes across the country. This often resulted in lengthy travel sequences for aircraft and crew. Imagine flying from Salt Lake City to San Antonio, then New Orleans, and beyond, all within the same journey. Unfortunately, such a web of routes meant delays could quickly cascade, impacting numerous flights. However, Frontier has opened 13 new hubs across the U.S. today, which is a fantastic step forward. Operational complexity has significantly reduced, with only 3.5% of flights not routed through one of these hubs. Now, many flights can operate as simple out-and-back journeys, and having more flights funnel through hubs allows for increased flexibility in managing and correcting delays. This operational efficiency leads to better aircraft utilization, ultimately lowering costs and enhancing the travel experience. While not all low-cost airlines have adopted transformative changes like Frontier, the industry is evolving. Competitors need to adapt to survive in this dynamic environment. For instance, Southwest Airlines has faced challenges post-COVID and reported a net loss of $231 million in the first quarter of 2024. Quite a departure from the impressive streak of profitability they enjoyed before the pandemic. Even CEO Bob Jordan acknowledged the need for change, highlighting the impactful lessons learned from previous operational disruptions during peak travel times. To navigate these challenges, Southwest is implementing strategic adjustments. They are scaling back operations in specific locations and reducing capacity in major hubs like Atlanta and Chicago. By streamlining their routes and reassessing staffing, including a thoughtful reduction of around 2,000 employees, Southwest aims to bolster efficiency. Additionally, they are exploring innovative methods to configure seating and boarding, moving away from the traditional no-assigned seating model and introducing new perks at a slight additional cost. But that's not all. Throughout March, Southwest introduced various tweaks that positively impacted operations, such as flying less during midweek, cutting back on short-haul business routes, and focusing more on flights during peak hours. Such proactive measures can lead to more manageable operations and ultimately enhance customer satisfaction. As these airlines undergo significant changes, they are attracting the attention of major investors. Recently, Elliott Investment Management acquired a $1.9 billion stake in Southwest, claiming about 11% equity in the airline. While the involvement of a firm like Elliott can seem daunting for any company, it also presents an exciting opportunity for transformative ideas and growth. Although primarily known for their expertise in restructuring high-profile companies, Elliott's interest signals a potential for positive change at Southwest. The arrival of activist investors generally encourages companies to explore fresh strategies and navigate challenges with renewed vigor. As companies look to bolster their value and service offerings, this injected interest can lead to innovative solutions that benefit customers and stakeholders alike. The sky's the limit for airlines like Frontier and Southwest as they chart new courses in the post-pandemic travel landscape. Travelers can look forward to enhanced experiences with simpler operations, bundled fare options, and a focus on reliability. While the journey ahead may have its share of twists and turns, it's heartening to see these airlines committed to improving their services and making travel more enjoyable for everyone. Here's to brighter skies and exciting adventures ahead in the world of air travel. Elliott's recent slide deck, released on their website, serves as a bold and insightful roadmap for the future of Southwest Airlines. Highlighting a key quote from the airline's legendary founder, Herb Kelleher, the presentation emphasizes the need for significant change, including refreshing the board and revitalizing leadership. Although CEO Bob Jordan has chosen to remain resilient amidst external pressures, the company is experiencing rising challenges, especially after filing an 8K form with the SEC. This disclosure revealed an expected drop in revenue per available seat mile, RASM, of 4 to 4.5%, a steeper decline than the previously projected 1.5 to 3.5%. This pivotal announcement underscores the urgency for radical transformation at Southwest. While the ongoing leadership shakeup is just beginning, it's clear that change is on the horizon for Southwest and similar low-cost carriers. Whether the instigation comes from internal decisions or external influences like Elliott's, the winds of transformation are blowing. Some experts have expressed concerns about Elliott's approach, fearing that their emphasis on short-term gains could jeopardize the long-term health of the airline. Additionally, industry insiders suggest that Elliott may not fully appreciate the unique qualities that have defined Southwest for the past 50 years. Nonetheless, there is a universal consensus. Southwest has taken too long to adapt. Leadership must embrace innovation and adaptability in today's challenging landscape for low-cost and ultra-low-cost airlines. The pressures from the current environment make it crucial for executives to evolve or revisit their career paths. A pressing question arises about the long-term viability of the low-cost carrier business model in the U.S. While this model thrives in densely populated regions like Europe, the vastness of the U.S. presents a different challenge, as cities are significantly spaced apart. The essence of the low-cost carrier strategy lies in optimizing and reducing operating costs compared to legacy carriers. They achieve this by minimizing ground time, utilizing secondary airports, and reducing labor costs. However, they face an unavoidable reality. They cannot lower fuel expenses, which remain constant across different carriers. For example, Spirit and United pay similar prices for fuel when flying from New York to Los Angeles. Yet, the long flight duration means fuel costs represent a larger share of overall expenses, leaving less room for minimizing other costs. As we move into 2024, rising fuel prices intersect with various external factors that challenge low-cost carriers' ability to maintain their traditional cost advantages. Operating as a low-cost carrier in the US is becoming increasingly difficult. Without the ability to keep costs low, the question becomes, what does that mean for their identity? While challenges abound, this juncture also represents a remarkable opportunity for transformation and innovation within the airline industry. Embracing change rather than resisting it will be crucial for the future success of low-cost carriers like Southwest. Exciting times lie ahead, and witnessing how these dynamics unfold will be fascinating. If you found this video insightful, remember to like, share, and comment below with your thoughts on the fate of budget airlines. Have you experienced any of these changes firsthand? Remember to subscribe to Rising Influence for deeper insights into business, the economy, and more. Thanks for watching, and see you in the following video.